Hi everyone, in today's lesson we're going to talk about monetary policy. In our last video we talked about fiscal policy and about the ways in which Congress and the president can manipulate the money supply in order to influence whether or not the economy is doing well or doing poorly. This time around with monetary policy, we're going to focus on the Federal Reserve and the tools in which they can use in order to stimulate growth or kind of shrink and slow down the economy. So make sure you're in your interactive notebook and you're following along. Okay, we're on page 7 of your interactive notebook. And again, we're talking about monetary policy today. Let's kick off with our essential question. How does the Federal Reserve help stabilize the economy? Monetary policy is going to be similar to fiscal policy, but we're going to have a couple different tools and we're going to have somebody else in charge of it. So it's very important that you separate fiscal policy from monetary policy. So monetary policy is how the money supply is influenced to bring the nation either out of a recessionary or in an inflationary period. So again, similar concept to fiscal policy, but we're going to have a different person or group, I should say, in charge, and we're going to have different tools in the way in which we're going to do this. So who controls monetary policy? It is not the president and Congress. It is the Federal Reserve. So again, very, very important that you separate fiscal and monetary. Remember, fiscal policy is controlled by the president and Congress. Monetary policy is controlled by the Federal Reserve. Now let's talk about what is the Federal Reserve. Pretty much it's a system of banks. It's like our main federal banks, all of the banks feed up to this one. And it's going to be the ones that influence the control of the economy through the money supply. It is nicknamed the Fed. So how does monetary policy work? It is going to work by adjusting the supply of money in the nation, and by adjusting or playing with that amount, it's either going to speed up or slow down the economy. Now, the first thing I want you to realize is when I say adjust the supply of money, I do not mean that the Federal Reserve is going to print more money, because remember, that's going to cause inflation. So we don't want that. There are other ways in which they can influence the money supply without printing more money. So let's talk about what they can do. In order to get out of a recession, the Federal Reserve is going to encourage people to spend by increasing the money supply. Again, not by printing it. We're going to talk about the way in which they can increase that money supply in a second. The flip side of this, in order to get out of an inflationary period or to kind of slow down the economy if it's growing too fast, they're going to discourage people from spending by decreasing the money supply. Again, just like fiscal policy, as long as you know one side of it, you're going to know the other side because it's the exact opposite. So just like fiscal policy, figure out what you know about the one or know it really well, and then that way you know the other side. So how does the Federal Reserve do this? There's going to be 3 tools that they can manipulate, we'll say, in order to influence the supply of money. Something called the reserve requirement, something called the discount rate, and something called open market operations. And I know you're all thinking to yourself right now, like, okay, I'm in the 10th grade. This seems like up here. We're going to explain all of them. So sit back and just write this down in your interactive notebook. Let's break down the reserve requirement. Now, this is the percentage of all deposits that a bank has to keep in its vault at all times. So when you go to a bank and you put money in, the bank actually can loan out your money. But in order to kind of cover their butt, they have to have a percentage that they keep in the vault at all times. And so this is a way in which we can manipulate how much money is in supply, because let's say that I'm a bank, the Bank of Pro, and I have $100,000 in deposits, and the reserve requirement set by the Federal Reserve is 10%. How much do I have to keep in my vault at all times, and how much can I lend out right now? So think about 10% of $100,000. I have to keep in my vault at all times at least $10,000, because that's 10% of $100,000, and that means I can lend out over $90,000, okay, just from my particular bank. So how does this affect the money supply? Let's think about if the reserve requirement is increased, that means the money supply that's out there is going to be decreased, and that's essentially going to contract the economy, all right, or it's going to shrink it. If the reserve requirement has been decreased, that means the money supply that I can lend out is increased, so that's going to increase the economy or expand the economy. Next, we want to talk about the discount rate. The discount rate deals with money that is lent out. So the Federal Reserve lends money to different banks. By lowering or raising the interest rate that the federal charges, the discount rate lowers the discount rate lowers or raises the interest rate that the Federal Reserve charges those banks. Whenever you go to take a loan out, they're going to charge interest on it. You're going to take out $10,000, but they're going to say you need to pay back 2% of that. So you pay back $10,000 plus the 2% on top of that. It's kind of like a fee in order to borrow the money. So the discount rate is going to influence the interest rate that the banks charge their customers. So again, let's look at an example. Let's say that the discount rate currently is 2%, and the bank is going to charge 3% for you to take money from them. Then the Fed decides to raise the discount rate. Now the discount rate has been raised from 2 to 3%. That means that the banks are going to raise their interest rate that they're charging their customers from 3 to 4%. The higher the interest, the less people are going to take out loans, because you're not going to want to say, I don't want to pay extra interest. I want to pay as little interest as possible. I want to go get a car. I don't want to pay, if the car is $25,000, I don't want to be paying 10% in interest and have to pay $2,500 back on top of that. It's too much. So we like lower interest rates as consumers. Now, let's say that the Federal Reserve decides to lower the discount rate. So now it goes from that 3% down to 1%. And that means that the banks are going to lower their interest rate that they're charging their customers as well. So it's going to go from 4% to 2%. Now people are like, yeah, we like this. So the lower the interest rate, the more people are going to get loans to go out and purchase things like houses and cars and, college loans or whatever they need. So how does this influence the money supply? If the discount rate is increased, that means the money supply is going to decrease. So that again is going to contract the economy. If the discount rate is decreased, then that means our money supply has been increased, and it's there going to increase or expand the economy. Now again, remember I'm saying the money supply is increased or decreasing here. I'm not printing or putting more money in circulation. I'm just kind of making it more or less difficult for you to have access to that money. The last tool that this Federal Reserve is going to use is known as open market operations. And this is a very fancy term for government bonds. A bond is like an IOU from the government. Selling a bond is going to take money out of circulation because you trade cash for that bond. So the government sells you a bond and you say, all right, I'm going to pay you $50 or $100 as the example says. The government's going to hold on to your $100 and you're going to hold on to this bond. It's going to look a lot like a check. And then later on, you're going to buy it back and you're going to get your $100 back and the government's going to be out $100. Buying bonds there is going to put money back in circulation because the government's going to give you back your $100 and you're going to go out and spend it. You can't spend the actual bond. You can only spend the cash. So again, this is another way that we can influence the money supply. If you sell your bond, if the government sells the bond, that means the money supply is decreasing. Because again, remember, the government sold it to you. You handed over your $100 and in return, you got the bond. So that's going to contract the economy. Now, when you decide to buy it back, you're going to go into the government and say, hey, I want my money back, or I want to, buy my bond back. The government is going to buy it back from you. And so that's going to increase the economy because you're going to trade the piece of paper in and they're going to give you back your $100. And now you can go out and spend that $100. So that's going to expand the economy. So monetary policy during a recession, what do we want to use to fix a recession? We're going to use what's called easy money policy. And there's going to be 3 tools that the Reserve uses that we've already talked about. So let's talk about what they do with these. The goal here is going to be to increase the money supply. Because remember, during a recession, we're not doing so well. The economy's not humming along. We gotta have to kickstart it or give it a kick in the butt. So giving more money to people or increasing the money supply is gonna generate that, oh, here's money, go out and buy stuff. So the Federal Reserve, they're gonna decrease the reserve requirement. they're going to decrease the discount rate, and they're going to buy bonds. Because remember, all three of these things are putting money or giving people access to money. Decreasing the reserve requirement is having more money lent out by the banks. Decreasing the discount rate is lowering those interest rates. So people are going to want to get those loans. And then buying the bonds, again, we're trading in that piece of paper. You're getting the physical cold hard cash and going out and spending it. To fix an period of inflation, it's the exact opposite. This is called a tight money policy, and we're going to use this to decrease the money supply. And again, it's going to be the exact opposite. The same three tools, but now we're going to increase the reserve requirement, again, making it more difficult to lend out money. We're going to increase the discount rate, again, that's increasing an interest rate, so it's going to make it less people are going to want to take out a loan, and we're going to sell bonds. You're trading in your money for that piece of paper, and you can't pay with that piece of paper. You can't go buy stuff. Okay, so again, as a quick recap, as you can see here, we've got easy money and policy, and we've got tight money policy. Know one, then you know the other. Make sure you separate it from fiscal policy. Know that the Federal Reserve is in charge of monetary policy. The president and government are in charge of fiscal policy. Once you know half of it, you know the other half because you just flip it on the other side. So make sure all of this is in your interactive notebook. Reach out with questions because I do know this is very advanced for a 10th grader, and it's a lot of information to take in. So again, make sure it's in your interactive notebook. Thanks for watching, and we'll see you soon.